the difference between currency and money. And I've been pounding the table on this since 2006. Currency has to be a medium of exchange, a unit of account. It's got to be portable, durable, divisible, something called fungible. Fungible means interchangeability. Like if you loan me a $20 bill, I can pay you back a completely different $20 bill, or I can give you a 10, a 5, and 5 ones. You don't care as long as you're paid back any $20. That interchangeability is fungibility. But money has to be all of those things plus a store of value. And if you're paying for something and it costs you twice as much this year as it did last year, you are paying with currency, not money. Money can store value over long periods of time. Currency cannot, by its very design, store value over long periods of time unless we're going into a deflationary implosion. And then it's not a long period of time anyway, but it will actually increase in value for a short period of time. The difference between what I call honest money so far is gold and silver. These are the only things that throughout history, if you look at the last 5,000 years of mediums of exchange, the predominant medium of exchange has been gold and silver. I've got an old Pegasus coin from 500 BC on my desk, and you can melt that down, and the silver in it has purchasing power. Now, it'll bounce up and down in purchasing power depending on how in favor or out of favor gold and silver are, but they never ever go to zero. They bounce up and down in this purchasing power range. And right now, they're very low in that range because we've come up with all these different other forms of paper wealth. There's paper dollars, there's stocks, there's bonds, there's just all these different places that you can actually store your purchasing power in.
Mike Maloney often talks about those moments when fear sweeps through the population and people rush back to real money, gold and silver, as a safe haven, skyrocketing their purchasing power. Maloney points out how, in the 1970s bull market, the price of gold multiplied by 25 and silver rose by 41 times in about 8.5 years, marking the biggest bull market of its time. According to him, while cryptocurrencies have seen impressive gains, nothing rivaled the size of the gold bull market back then. Maloney also likes to highlight how honest money, gold, makes transactions fair and transparent, as each transaction requires real value exchange. He explains that when you make a gold coin, you're not just creating something from thin air. There's a whole process: prospecting, establishing claims, mining and refining the ore, and minting the coin. To save up enough gold coins to buy a house, for instance, you'd have to put in work equivalent to the effort involved in creating that gold. In Maloney's words, the value of that house should reflect the work that went into building it, digging up the foundation, cutting and shaping the materials, and refining metals like copper for wiring. That cumulative work equals the work required to create the gold you're using to purchase it. In the end, it's a fair transaction of equal values, unlike fiat currency, which he describes as inherently fraudulent because it's created without equivalent labor or value.
With currency, you go into the bank, you say, loan me something, and they imagine this into existence, diluting the existing currency supply and transferring wealth from anybody that's holding currency to this newly invented currency. So that's theft. And then you're going to buy a house with nothing, and you're going to get something for it, and that's fraud. And so that's the difference between honest money, gold and silver, and fiat national currencies. If you're in a decade, let's say your home doubles in price, did it double in value? Well, if you're going to measure it against other real estate, absolutely not. It didn't go anywhere. If you sell it, you could buy one about the same in the same neighborhood for the same amount of dollars or whatever you're measuring it with. If you're measuring it with money, gold and silver, or if you're measuring it with barrels of oil or groceries or gasoline, if you sell that house and you can buy twice as much groceries and gasoline with it, or shares of stock with the proceeds from selling that house. But if over a 10-year period of time, let's say, the house doubles, but the stock market quadruples, that means the house doubled in price, but its value compared to stocks fell by 50%. Because when you sell the house, you could only get half the amount, the shares of stock that you could have gotten if you had just spent the currency. Even though it was half the amount of currency, you would have gotten twice the amount of shares of stock. The same thing goes with, like, if inflation is raging, your house doubles in price, and you sell it, and all the groceries and gasoline have quadrupled, you can only buy half as much. So the house doubled in price, but went down 50% in value while it was doubling in price. That's the difference between price and value. Asset classes, gold, silver, oil, stocks, real estate, and several other things, going back into the 1800s, so more than 100 years worth of data. And what you see is that when you measure stuff with other stuff, nothing goes up permanently. Everything appears to go up in price. It keeps on going up and up and up. I mean, a house back in the Great Depression, a single family median price home might have been $2,500, $3,000. Now it's $300,000. So it's 100 times higher than it was then in price. The house actually, though, for the number of work hours it takes to buy that house, has actually gone down. This is the currency changing, not the house. The house didn't change. Everything runs in these waves and cycles. One asset class outperforms another one for a certain number of years, and then one becomes too overvalued, the other becomes too undervalued, and they switch and get a bull market. It's gold and silver's time, basically. You know, they had that bull market in the 70s, and in the middle of that bull market, there was a huge correction, a mid-cycle.
Mike Maloney often discusses this long secular bull market in precious metals, which he says started with a powerful rally that lasted until the end of 1974. Then in 1975, prices pulled back, dropping 50% from $200 to $100 before climbing again. Over the next few years, gold hit an end-day high of $873. Afterward, it entered a 20-year bear market, but Maloney points out that the current secular bull market is even larger in both magnitude and duration than the one in the 70s. According to Maloney, we're in a mid-cycle correction now, which began in 2011 and has felt slow and even dull. However, he believes this prolonged cycle shift from other asset classes into gold and silver, which began around 2000, is still underway. He's steadfast about sticking with the cycle, determined to hold through corrections, and even add to his position, confident that the next 1 to 3 years will bring substantial rewards. Maloney warns that a crisis is on the horizon, explaining that the level of economic manipulation and distortion we're seeing now inevitably leads to consequences.